RBI Governor Raghuram Rajan kicked off the new year with a surprise rate cut that delighted the markets. Expectations of another rate cut in the quarterly policy review were low. And sure enough, Rajan left the repo rate untouched but did cut the SLR by 50 basis points. So has the war on inflation been won? ET's Bodhi, Satva, Ganguly and Sriram Ramakrishnan in conversation with Governor Rajan.
Thanks a lot, Dr. Rajan, for agreeing to meet us. If I could start off by asking you, given the data that we've been seeing so far in the last couple of months and given the rate cut that happened on Jan 15th, are we to understand, can we assume that India is winning the war against inflation?
Well, I think thus far we're very, very far from where we started. Remember, when we started on this path of disinflation, people said, abandon all hope. There's no chance that you would ever get near 6%. And today we are at 6% a year ahead of time. In fact, we are at 5%. And people are saying, we've done it, we've won. I'm not so confident that we have won, but I'd say we're very, very far from where we started. And what is important to win is to have credibility in the economy that when inflation picks up again, as inevitably there will be forces that will push it up over time, that the central bank will act and will bring it down again. And once we have that credibility, then we have low sustained inflation for a much longer period. Now, this requires everything to work together. The government, of course, through fiscal as well as management of supply, the RBI through its management of liquidity as well as its management of interest rates, and the external environment has to cooperate. But what we need to aim for is a situation where if there are supply shocks in the future, it doesn't immediately result in an increase in inflationary expectations, that people suddenly think, okay, supply shock, so again we're going to see high inflation, and we actually see it. We should be able to see through those shocks in the future because there's enough of a sense in the public that we've brought inflation under control. That would be the longer term aim. That is when I would say we've actually won the war.
So your target is actually 4%, right? As per the Urjit Patel committee report, it was 4% by Jan 2016.
No, our target is 6% by Jan 2016.
Your target was, but you've already hit that, right?
And we're not trying to. I've said in other quarters, we're not trying to increase the pace of disinflation beyond what we think is reasonable for the economy. Of course, the eventual target, which I think there is buy-in from the government at this point, would be a band of 4 plus minus 2. So when we get to 6, we are within the band. When we get below 6. But my guess is comfort levels would be to go towards the middle of the band, but there would be a time frame, again, once the framework is ironed out in detail, in which to achieve the middle of the band. It won't be on day one, we have to be at the middle of the band.
What are the things that keeps you awake at night when it comes to inflation? What are the things that really worries you going forward?
Well, clearly food management is an issue. We have had difficult monsoons, and we have managed food during those difficult monsoons in a way that we haven't had substantial inflation. But we need to ensure that the full gamut of management tools we have, releasing some of our buffers, importing if necessary, enhancing the logistics, enhancing storage, private storage, not just storage through FCI, but private storage, especially of vegetables. All these things, I think, there's work underway, but my sense is when all these things come together, the kind of food shocks that we had in the past will diminish. Now, food across the world is volatile. The problem is it's such a big part of our basket, and correctly so, because so many people, for them, it's a big part of their budget. But given that our inflation is more volatile than the inflation in other countries, and so we can relax a little less.
What is your estimate though of the balance? I mean, you touched on some of this, but in terms of the balance of macroeconomic forces, do you think it is favorable, in terms of downward pressure on inflation? What would your estimate?
Of course, because one is there are forces in the rural economy which are keeping rural wages subdued. Now, the negative side of it is, of course, it affects rural demand. The positive side of it is that rural wages become the base for which other wages are determined. For example, wages in construction, wages for unskilled labor elsewhere. And those subdued wages are keeping a lid on wage price inflation. So I think this is something that has been playing out. It may not be only a function of subdued conditions in rural areas. It may also be that the rapid growth we saw, substantial real increases in rural wages, was a period of catch-up. And after rural wages caught up to productivity, they've slowed. Now, this is something we need to explore. It's just a conjecture that I'm putting forward. But it may not be something to be overly worried about. It may be that after the period of catch-up, we've slowed. It may also be that rural wages are more subdued for a variety of other policy reasons. But that's one thing that gives me a little bit of comfort. The fall in oil prices, which has yet to be fully passed through into this economy, is another factor which gives me comfort on inflation. The third is, again, this is a mixed bag, but the relatively stable exchange rate means that we are not importing inflation. In fact, we're importing the disinflationary or even deflationary conditions in the rest of the world. And that would again help in containing inflation. Of course, as I've said in a number of other places, we also have to worry eventually about becoming having an exchange rate which is too strong, which is uncompetitive, and that's something we need to keep our eye on.
Is that where your worries are coming from regarding competitive devaluation? And
well, I do worry that the whole point about monetary policy and its effect on the exchange rate was, yes, if you cut interest rates or have accommodative monetary policy, the exchange rate will weaken. That's a natural consequence. It will make your exports more competitive, but you're also not hurting the rest of the world because your economy is growing for other reasons. As you cut interest rates, there's more credit, there's more demand being generated by your economy. And the general sense was that would offset the demand shifting effects of a weaker exchange rate. The demand creating effects of the lower interest rate would offset the demand shifting effects of a weak exchange rate. My point has been that in the West, the demand creating effects have been minimal, while the demand shifting effects have been pretty significant. And if QE works largely through a more competitive exchange rate, it is something for the world to be concerned about, because this is a form of beggar thy neighbor monetary easing.
what are the risks to India from this blast of easy money flowing from everywhere, from Tokyo to Paris to Brussels to...
See, first, the assumption in these statements is that unconventional monetary policy is demand creating. If it was that, then I would be less worried about it, because at least it's putting the economy back on track. But if it is either demand creating in unsustainable ways, that it's creating a wealth effect, because stock markets boom, bond prices boom, only to go away when you shift policy, then you may be stuck in a Chakravyuh. You can't change policy because that would bring all the asset prices down back to earth. and that would reverse the very wealth effects which contributed to growth. I mean, this is one of those policies which is meant to be a bridge, that at the end of the bridge, you can walk off and nothing happens. But if the bridge stops halfway, you walk off and you plunge. And that's my concern, that you can't get out of these policies. My worry is that you're riding a tiger with these policies. And you can already see the Fed, after having engaged in very aggressive QE with exchange rates, the US exchange rate being relatively weak, even though the US economy was strong, now is seeing the consequences of emerging from it, which is the US exchange rate strengthens. And then concerns emerge about, okay, exit is painful because it reverses the effects. And this is what happens when you're not having a natural sort of increase in the economy because of more credit, more spending, but you're shifting demand. And so the demand shifts back when you reverse these policies. So I worry that that these are what do they call it? Placebos, not real medicine, and they also fool economists into thinking something real is going on. For India, of course, this means a lot of money seeking a home. Now, India is a good story. We welcome money that wants to, participate in that story, which is going to stay for the longer term. But we worry about money which basically says, I need to find returns for the next 6 months, and until interest rates start popping back up in the West.
So that's why you took some of the measures that you did announce yesterday, the short term.
Well, we found a lot of money coming into the short end of the corporate bond market. Now, I am generally a believer that we should not micromanage. We should allow more freedom. But the one place where I do make a strong exception is on financial stability. That there are situations where market participants do not fully internalize the consequences of their actions. Sometimes because they know they can leave before the consequences hit them. And so I would like them to internalize a little more. It's not that when we say reinvest in 3-year plus maturities, that they can't sell those bonds and leave. But it is that they have to think twice before getting in, because it's a little more difficult to sell than an overnight investment or a 1-month investment.
You also talked about bulletproofing the balance sheet, to prepare for the inevitable rate hike by the US Fed. Talk us a little bit through that and what you.
Well, first, I think when you bulletproof a company balance sheet, the best way you bulletproof is through policies. If you have solid policies that your investors can trust, then there may be a little bit of turmoil, but they'll stay. So what are the policies that we have to focus on? One, of course, is growth. We need to get back growth, but we look reasonable, even with the old series, relative to our comparator economies, right? Except for China, we're one of the fastest growing economies in the world, even in our extreme slowdown. So if that turns around, which I fully expect it will, we look a lot better. So not only is the level good, but the expectation of a turnaround is also strong. The second, I think, aspect is we have brought down inflation. One of the most pernicious aspects to the Indian currency was that with the high rates of inflation, there would be eventually a depreciation to maintain competitiveness. We're still above the rest of the world as far as inflation goes. Not the rest of the emerging world. Brazil has higher inflation than we have, for example, today. But still relative to the industrial world. I don't think we are going to necessarily catch up with that. We don't want to catch up. We don't want deflationary conditions. But my sense is as we go towards 4%, we will be in a much more comfortable level without the need for depreciating the currency on a regular basis. War. The third element is, of course, fiscal. That if there is a sense that our fiscal policies are sensible, are constrained, I think that will again add to the picture of macro stability. And the fourth is a current account deficit, which was already coming down, but with oil will probably go below 1% in the coming year. So you put these four together, that to my mind is the first line of defense. The second line of defense is our reserves. That is, your policies are reasonable, investors want to stay in, but we also have enough reserves that if some untoward accident happens, for example, oil prices shoot up, we can afford to pay for it. We're not constrained. And of course, flip side of reserves is don't incur too much debt.
So there was a suggestion recently in the the Finance Ministry's mid-year economic review that given the continuing weakness in private investment, the government could step up investment, and therefore there was a suggestion, perhaps for purpose of public discussion, that the fiscal deficit targets could be relaxed. So what you would be against it? I mean that or.
No, I don't. What we said yesterday in the monetary policy statement is that you want to look at the overall package. If there are investments that are ready to go, that are important to make, that would add to the growth environment, and where we have confidence that they will indeed be completed on time, we should do them. They will add to that element of stability, which is a strong growth picture. On the other hand, if we expand the fisc considerably, but put it into revenue spending, which is not creating assets, etc., having one of the highest fiscal deficits amongst the emerging world, we have to be worried about what kind of picture that sends, right? Undoubtedly, the trend has to be towards more and more fiscal consolidation. And the goal of 3% that we have is a reasonable one. The goal of reaching 3%. So we have to, try and get there. The quality of how we get there also matters. That if we get there through, moving from mistargeted subsidies towards more capital expenditure, that's a lot better than moving there by pushing and pulling spending across years. So I think the package is what we were looking for, because historically there's been a correlation. I mean, look, I'm not here to tell the government what to do. The government does what it wants to do, what it needs to do, given the needs of the people. My only concern has to be how this plays into inflation, which is my mandate. And to the extent that there is fiscal spending that adds to inflationary pressures, and historically we've seen that happen, I have to be worried. So that is my main concern. And if there's a sensible package of how we will do this over time, my concerns are alleviated.
But there are numbers which the government is committed to: 4.1 for this year, 3.6 for the next, and 3% by the year ending 31st March 2017. To what extent should these numbers be sacrosanct?
No, my sense, again, let me emphasize the package. It's what you do, how you do it, what is going on, that we have to take an overall look at, and then decide how it plays into inflation. So I am not going to be more specific than that. We have to see a package.
Given the savings that you've had on the account of oil price fall, and given the fact that Aadhaar is being pushed in a more determined manner, and the government is moving toward a direct benefit transfer system for a whole range of subsidy payments, services, and all that, what in what is the impact in your view of this on the fisc and the government spending?
Well, I'm hopeful that this implies better targeting, that as we can send the subsidies directly, you don't need to subsidize the product. You can subsidize people. And if you don't subsidize the product, the kind of leakages we see can diminish. I mean, there are all these horror stories, for example, of fertilizers. We are feeding our neighboring countries fertilizer, and we're seeing fertilizer being misused for the wrong purposes. We're seeing certain fuels being used to adulterate other fuels because they're extremely cheap. These are all concerns which diminish once you send the subsidy directly to the user based on usage, rather than cheapen the value of the product in the market. So that form of leakage diminishes, but also you can pick which users you want to subsidize. And my sense is both those things can be done, which will bring down the level of subsidy spending considerably.
Do you see growth picking up? And is there any kind of, is there a chance that, what do you see as the potential, India's potential growth rate right now?
Depends on which series you want me to talk. Look, I feel comfortable talking about the old series because I don't understand the new one as well. And I think we, come February 9th, come greater disclosure, we are doing deep dives into what is going on. I think that I would see potential growth is a very nebulous concept. Because does it mean potential given constraints? Does it mean potential without constraints, etc.? I think given the capacities we've built up and given the kind of constraints on supply that still exist, even though they're being combated, one could argue that potential growth is between 6.5% and 7% right now. And at 5.5%, we're still below potential, but at our projected 6.5% for next year, we should be much closer to potential. So that would be the statement I'd feel comfortable in making, given the old series. Of course, if we can do a lot on expanding capacity, both human capital as well as physical capital and infrastructure, our potential growth will go up. And that way, what is our limit? I don't think, we should be settling in the medium term for anything less than double-digit growth. We need to go back to double-digit growth. But for that, we have to do a lot of homework on the financial side, on the human capital side, on the physical and infrastructure side. But I don't think that's out of the question.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.